Welcome to this edition of Ethical Sustainable Investment News and Analysis to Profit By. I'm Ron Robbins, an ethical investing pioneer for over 40 years, quoted in the Wall Street Journal, Market Watch, the Globe and Mail, and numerous other media, and founder of the highly respected global ethical sustainable investing information website, Investing for the Soul. And please listen to my disclaimer statement at the end of this podcast. Now enjoy this podcast. Hello, Ron Robbins here. So welcome to my podcast episode 109, titled Great Green Energy Stock Picks. It's presented by Investing for the Soul. Investingforthesoul.com is your site for vital global ethical and sustainable investing mentoring, news, commentary, information, and resources. And look at my newly totally revised website at investingforthesoul.com. So remember that you can find a full transcript and links to content including stock symbols and bonus material on this episode's podcast page located at investingforthesoul.com/podcasts. Now, if any terms are unfamiliar to you, simply Google them. Also, a reminder, I do not evaluate any of the stocks or funds mentioned in these podcasts, nor do I receive any compensation from anyone covered in these podcasts. Furthermore, I will reveal to you any personal investments I have in the investments mentioned herein. Additionally, quotes about individual companies are brief so that I can get as many companies covered as possible in the time allowed. Please go to this podcast webpage for links to the actual articles for more company and stock information. Links to an additional 3 articles are included below. I apologize if there's any extraneous noise buzzing in the background here. There's some construction work going on nearby. Now, the first 2 articles are from Canada, but they detail opportunities relevant to a global audience. The first article is titled, How Green Energy Players Are Making Big Waves in the Stock Market, by Christopher Liew on 4.ca. Here's some of what Mr. Liew has to say about his 3 picks. 1. Ballard Power Systems. Market analysts recommend a hold rating. The 12-month average price target is $22.91, or 293% return potential. Ballard's competitive advantages include experience in manufacturing fuel cell products, 40 years now, top-tier long-term customers, and strategic shareholders. The latest product and potential growth driver is next-generation, thin, flexible graphite bipolar plates. Ballard plans to invest around $18 million in manufacturing the plates this year through 2025. Second company, Nano One Materials Corp. Nano One outperforms the Toronto Stock Exchange year to date, plus 18.85% versus 1.11%. Market analysts recommend a buy rating with an average price target of $6.50, that's plus 124% in 12 months. This $302 million company's contribution to the fight against climate change is the production of high-performance lithium-ion battery cathode materials. According to management, the company's technology applies to electric vehicles, energy storage, and consumer electronics. Besides reducing costs, the low carbon intensity improves environmental impact. Nano One owns Canada's only lithium ferrous phosphate battery production facility. 3 is Exro Technologies. Exro Technologies develops new generation power electronics that expand the capabilities of electric motors and batteries. The significant upside will come from continued focus on innovation in e-transition and energy storage market verticals. The addressable markets for its lead products, coil driver, motor controllers, and cell driver, energy storage, should reach US $133 billion and US $224 billion by 2030, respectively. Market analysts recommend a strong buy rating, forecasting 55% price appreciation in 1 year. End quotes. Now, the second article is titled 2 Canadian ESG Stocks for Ethical Investors by Adam Othman on Fool.ca. Among Mr. Othman's comments on his 2 picks are these. 1. Canadian National Railway. Might not seem like an ESG stock. However, this Canadian dividend aristocrat can be an excellent investment for this purpose. The $105.92 billion market capitalization company, headquartered in Montreal, is vital to the North American economy. Boasting the only 18,600-mile railway network connecting 3 coasts in North America, it generates solid financial results. In 2022, it increased its revenue by 18.2% and net income by 4.5%, increasing its free cash flow by 29.2% compared to the previous year. Sustainalytics gives Canadian National Railway stock a low ESG risk rating due to its climate action plan aligning with international ESG standards. 2. Innergex Renewable Energy. The $2.73 billion market capitalization company develops, owns, and operates run-of-river hydroelectric facilities. It also has a substantial number of wind and solar energy farms located in North and South America and France. Operating as an electricity utility company, it has a low-risk business model. 2022 saw Innergex reduce its net loss from $185.4 million in 2021 to $91.1 million. Its free cash flows rose by almost 60% year over year. As of this writing, Innergex Renewable stock trades for $13.39 per share, down by 34.55% from its 52-week high. Currently, it pays its shareholders their payouts at a juicy 5.38% dividend yield. End quotes. And now to a company that's often overlooked according to this stocks analyst. The article is titled, Why This Under-the-Radar Renewable Energy Stock is a Strong Buy. It's by Benjamin Rains and found on Zacks.com. Here's some of what Mr. Rains says about Arcosa Inc. Arcosa Inc. provides infrastructure-related products and solutions across construction, engineered structures, and transportation markets. Arcosa is benefiting from megatrends such as aging infrastructure, as well as the continued shift to renewable power generation and the expansion of new transmission, distribution, and telecommunications infrastructure. Arcosa crushed Zacks' Q1 earnings estimate in late April and provided hugely upbeat guidance. Arcosa's fiscal 2023 consensus estimate has surged by 44% since its report, with fiscal year 24's figure 38% higher. Arcosa's bottom line positivity helps it grab a Zacks rank number 1 strong buy. Arcosa's engineered structures division includes utility structures, telecom structures, wind towers, and beyond. Arcosa's wind tower business is booming since the passage of the Inflation Reduction Act. The gusts at Arcosa's back include grid hardening, electrification of vehicles, connecting renewable energy to the grid, the wireless 5G telecom build-out, and more. Zacks estimates call for Arcosa's adjusted 2023 earnings to surge by 27% and then jump another 18% higher in 2024 to reach $3.26 per share. Overall, Arcosa appears to be a somewhat under-the-radar and strong way to gain exposure to multiple long-term trends in the US and global economy, and its recent slip sets up a better entry point. End quotes. Next is this article, also applicable to a global audience. It's titled 5 Top UK Sustainable Investment Trusts to Consider in H2 2023. It's by Gaurav Sharma and seen on Forbes.com. Here are some quotes. Typically listed on UK and Japanese markets, investment trusts are public listed pooled investment vehicles that generate income by investing in stocks of other companies, bonds, both corporate and government issued, real estate, infrastructure, and privately held enterprises, etc. Based on current dividend yields, net asset value discounts, and exchange rates, for me, the following 5 UK listed sustainable investment trusts stand out. 1. Triple Point Energy Transition plc. Dividend yield 8.27%. Listed on the main market of the London Stock Exchange, Triple Point Energy Transition plc invests in UK and European renewable energy projects, touting its credentials as a stable, dividend-paying trust that aims to enable a pan-European transition to a low-carbon economy. Furthermore, its 7 to 8% average dividend yield not only ranks it among the highest in its category, but also puts it on the list of the 20 highest dividend yields among all UK-listed investment trusts. 2. Next Energy Solar Fund. Dividend yield 7.52%. Next Energy Solar Fund is listed on the London Stock Exchange main market and is a constituent of the FTSE 250 index. As the name suggests, it invests in a diversified portfolio of solar energy and energy storage infrastructure assets. Most of its long-term cash flows are inflation-linked via UK government subsidies, and it offers an attractive dividend yield. 3. Renewables Infrastructure Group. Dividend yield 5.97%. Renewables Infrastructure Group has been listed on the London Stock Exchange for over a decade and is also a constituent of the FTSE 250 index. The company focuses on onshore and offshore wind farms and solar parks in the UK and Europe. 4. Octopus Renewables Infrastructure Trust. Dividend yield 5.52%. With its management trail leading to one of Europe's largest renewable energy investors, Octopus Energy, the Octopus Renewable Energy Infrastructure Trust aims to provide both capital appreciation as well as sustainable dividends by building and operating a diversified portfolio of renewable energy assets in Europe and Australia. And number 5, Greencoat UK Wind plc, dividend yield 5.51%. Greencoat UK Wind has the honour of being the first UK renewable infrastructure fund to list on the London Stock Exchange. It is also a constituent of the FTSE 250 index and is focused on UK wind power generation. End quotes. Now, the US economy is currently being lifted by 2 massive spending bills related to infrastructure. Many ethical and sustainable investors see infrastructure companies as having a place in their portfolios. So this article might be of interest to many of you. It's titled 20 Biggest Infrastructure Companies in the US. It's by Haqqi and is seen on finance.yahoo.com. Now, only the public companies and non-fossil fuel related are included here, and quotes about these companies are limited. Starting with what comes out as number 14, Crown Castle Inc. Total revenue $58.1 billion. Crown Castle provides shared communications infrastructure in the US, including small cells, cell towers and fiber, and counts itself among the largest US infrastructure companies. At number 13 is Fluor Corp. Total revenue $13.8 billion. Fluor Corporation is one of the biggest engineering companies in Texas. The share price of Fluor Corporation has stayed the same over the last 1 year, with its gains being wiped out over the last few months. 12. Norfolk Southern Corporation. Total revenue $12.7 billion. Norfolk Southern Corporation is one of the biggest railroad companies in the US, not to mention among the largest infrastructure companies in the US. Norfolk Southern Corporation has been in the news for the past few months for a massive derailment in East Palestine, Ohio, which resulted in the release of tons of toxic chemicals and has recently been sued by the Department of Justice for the same. 11. American Tower Corporation. Total revenue $10.7 billion. American Tower Corporation owns and operates wireless and broadcast communications infrastructure, not just in the US, but in several other countries as well. Coming in at number 6, CSX Corporation. Total revenue $14.9 billion. CSX Corporation is engaged in the business of real estate and rail transportation and is headquartered in Florida. CSX Corporation's return on equity has exceeded the industry average in the past, though part of that is because of the company's high debt portfolio. And at number 3 is Union Pacific Corporation. Total revenue $24.9 billion. Union Pacific Corporation is the largest railroad company in the country and one of the largest infrastructure companies in the US, and has provided a return of 61% to its investors in the last 5 years. And number 2, AT&T Inc., total revenue $120.7 billion. AT&T Inc. is one of the biggest telecom and mobile telephone services companies, not just in the US, but also the world. Recently, AT&T Inc. raised over $4.2 billion in an attempt to buy out wireless minorities. And coming in at number 1, Comcast Corporation, total revenue $121.4 billion. Comcast Corporation is among the most valuable telecom companies in the world, and its stock is favored by institutional owners who own around 85% of the company's stock. End quotes. Now, 2 other honorable mentions. 1, title, 5 Top Alternative Energy Companies on builtin.com by Margot Steins. 2, title, Why T. Rowe Price Group is a Top Socially Responsible Dividend Stock on nasdaq.com by BNK Invest. And 1 article from Australia, title, The Ethical Investor, El Nino is back, but there's one ASX company that could benefit from a potential drought, by Eddie Sunato on stockhead.com.au. Well, these are my top news stories with their stock and fund tips for this podcast titled Great Green Energy Stock Picks. Now, please be sure to click the like and subscribe buttons on Apple Podcasts, Google Podcasts, or wherever you download or listen to this podcast. That helps bring these podcasts to others like you. And please click the share buttons to share this podcast with your friends and family. Let's promote ethical and sustainable investing as a force for hope and prosperity in these terribly troubled times. Contact me if you have any questions. Thank you for listening, and wishing you a wonderful Independence Day if you live in the US, and a terrific Canada Day should you live in Canada. Talk to you next on July 14th. And again, look at my new totally revised website at investingforthesoul.com. Tell me what you think. Bye for now. Learn how to create a simple portfolio reflecting your personal values by taking my 1-hour tutorial. Go to investingforthesoul.com/podcasts and click the link in the right-hand column for my DIY Ethical Sustainable Investing Pays tutorial. Now, I'll mention in the podcast if I have any direct interest or holdings in companies or securities I'm talking about. Furthermore, any news, opinions, analysis, or other information offered by myself, as well as references and information to or from other external sources in this podcast, is provided as general market information and should not be relied upon, and thus does not constitute investment advice. Investors should consult their own licensed investment professional before making investments. Also, I will not accept liability for any loss or damage, including without limitation any loss of profit, which may arise directly or indirectly from use of or reliance on information in this podcast. Do contact me at ronr@investingforthesoul.com. Signing off, this is Ron Robbins.